So I want to thank everybody for showing up today. Appreciate it. I know it was a little bit last minute trying to get this seminar put together for you guys. And what we wanted to talk about today is the new California AB150. Technically, it's not too new. It passed sometime around July, August of earlier this year, but it just started to really pick up headwind in the last month or so. And what I want to try to do today is explain what AB150 is, how we as business owners might be able to profit from AB150, and then go through some examples because this is pretty complicated. So I'm going to apologize now ahead of time because this is going to be pretty heavy tax intensive and not really, it's hard to explain. No other way to get around it. It's just a brutal topic to try to go through in a class seminar, but hopefully we can give you enough information so you know what questions to ask about your particular situation. So as I stated, one thing we want to do is explain AB 150, who qualifies for it, what are some of the pros and the cons that we are seeing right now, and is this the right fit for us? And in not all cases is it going to be. I mean, it seems like a no-brainer right off the bat, and then you're gonna find out that where California giveth, California taketh away, and it may not be the best for all people involved. So let me go back. Let's give a little bit of history about this first. So going back to 2018, under the Trump administration, there was the Tax Jobs and Cuts Act, Tax Savings Act. And basically, one of the provisions that took a lot of heat in that provision was the limitation of the of our state and local income tax deductions, also referred to as the SALT deduction. And basically what that did, or what that was, is when we pay taxes to the state of California, whether it's withholding taxes or estimated taxes, property taxes, vehicle registration fees, sales taxes in some cases. Pre-2018, we were allowed to take a full deduction for those taxes paid to California on our federal income tax return. And then as part of the TCJA, the law capped those deductions for the state and local taxes to $10,000. And what this looked like, if you want to see, is here's our itemized deductions. And again, this only applies if you are itemizing on your taxes. And let's say I had state withholding, for out of our W-2s or our estimated taxes of $100,000. And then we had property taxes of 12. So we paid to California $114,000 in state taxes. Pre-2018, we were able to take a deduction for this $114,000. After the TCJA went into effect, we are capped at $10,000. So this was a pretty big hit for people living in high tax states like California, New York, and those other states, Chicago, or Illinois, sorry, Chicago isn't a state. But so we had the $10,000 deduction, right? And so states then started to think, how do we get around this SALT cap? California in 2018, I don't know if many of you remember back that far, but California tried to pass, let's see what their tax law was. It was California Senate Bill 227. And what California tried to do, and this is what the bottom half of the screen is about, is they said, since we could only take a deduction of $10,000 as the state and local taxes, what we as California are going to allow is if you make a charitable contribution to us, in here, I put it down here. If you make a charitable contribution to the state of California for the excess that you're not able to take as taxes paid, we will give you a charitable contribution that you could deduct on your federal tax return, lowering your federal taxable income. And we will give you credit on your California income tax return for those taxes paid. And so here, the $114,000 in state and local taxes, what California was proposing is we take $10,000 of those as a state deduction, and then we take the other $104,000 as a charitable contribution, coming back up to a total itemized deduction of the $114,238 that we would have had we been allowed to deduct all the taxes. Now, The IRS said, no, we're not going to go for that. Because under a charitable contribution, the IRS's position is, if I give money to charity, I cannot receive anything in exchange. And here, what I'm getting in exchange is a California tax credit. So the IRS quickly shot that down, and that left California and other states trying to scramble for ways to work around this $10,000 limitation that was in place by the TCJA. So fast forward to 2021, and now all of a sudden we come up to AB150, Assembly Bill 150. And Assembly Bill 150 is California's new attempt at a workaround on that $10,000 limitation that we are allowed on our individual tax returns. And so what Assembly Bill 150 says is basically, if I have an entity, a flow-through entity, an S Corp, a limited liability company that's being taxed as a partnership, a general partnership, the entity itself can pay taxes to California on my behalf. So basically, the entity would claim a tax deduction on their federal tax returns for that payment, that elective payment. And then when I receive my K-1, the information reporting that shows how much profit I have to report as taxes from that entity, that federal K-1 will be reduced by the amount of elective taxes paid in. And so this was their workaround on the $10,000 SALT limitation. Now, some things that I briefly touched on. This is only available for pass-through entities, S corporations, limited liability companies being taxed as a partnership, general partnerships, and not available to the general public at large. So if we looked back at the Assembly, the Senate Assembly bill, that would have been available for all individuals, right? Anybody paying California taxes would pay directly to California as a charitable contribution and deduct the charitable contribution on their individual tax returns. Unfortunately, AB 150 is only available for these entities, the pass-through entities. The payment of the California elective tax, like I said, decreases your federal net taxable income on the K-1. And then the trick about it is when we file our California tax returns as individuals, we're going to pick up a tax credit for the amount of that elective tax the entity paid in. So basically the entity, let's say that's California, and I'll go through it a little bit more. My entity, my S corporation, pays $50,000 to the state of California as an elective tax. When I get my K-1, I'm going to have a $50,000 credit for California state taxes. In effect, I'm reducing my federal income by $50,000. My California income stays the same, but I pick up a $50,000 tax credit. So it sounds like a no-brainer for almost any entity to do this, but there are some caveats, and we're going to touch on those lightly. So again, how it works, as I stated, and I'm not going to go over too much, the entity pays the California tax. Entities are not limited to a SALT deduction. If an entity has $100,000 state tax liability, the entity could claim the whole liability or the whole tax as a deduction. So entities are treated differently than individuals. And so, as an example, the law office of Steve Schroeder has a qualified net income of $100,000. So that would be the K-1. That would be the profit if you're looking at QuickBooks at the end of the year. So this is your $100,000 of pass-through income that's going to flow through. I'm 100% shareholder. I make the election to have the corporation, my corporation, pay to California the $9,300. Now, it's 9.3%. So it's not an arbitrary amount. It's 9.3% of the net income. This 9.3% cannot be lower. So if you have qualified business income of $1 million, it's going to be 93,000. If you have anything less, we're going to multiply it by this 9.3%. So how it works out is my federal K-1 is going to report the $90,700, this $100,000 K-1 minus the $93,000 elective tax. So I've in effect reduced my federal taxable income $9,300, right? My California K-1 is going to still show the $100,000. And then what happens is on my California K-1, I'm going to pick up a tax credit of $9,300 that will help offset my individual income tax obligations. Now, some good news. California is not the first state proposing this. Many states have already started this up, and the IRS and IRS Notice 2020-75 has said that they agree with this kind of treatment for tax purposes. So we got the IRS's blessing on the California AB150, where we didn't have it on the charitable deduction side of things. So that's been all good news too. So we know the IRS is not going to scrutinize these type of transactions. They've given their blessings to them. So who qualifies? I touched on this. So C corporations do not qualify, right? They're not a flow through entity. LLCs being taxed as a corporation do not qualify. They're not flow through entities. What does qualify are S corporations, limited liability companies that have being taxed as a partnership, and partnerships in general. Sole proprietorships, so all you people that file Schedule C are not incorporated, they do not qualify. Single member LLCs do not qualify. So there's some planning strategies as you head into 2022, unfortunately not so much for 2021, is if you are a Schedule C and you're thinking maybe I want to try to take advantage of this AB150 SALT tax limitation workaround, consider incorporating, for 2022. If you are a single member LLC, maybe elect to, have your spouse, if you have a spouse, added on to the LLC, elect to be treated as a partnership. So we move up to the entities that qualify for this workaround, okay? But right now, Schedule C filers, self-employed, single member LLCs, C corporations, they do not qualify, okay? As I said, the relief, if you're thinking from a tax planning standpoint, only becomes available for me as a sole proprietorship after the date of incorporation. So I can't incorporate December 10th and then have all the income I earned from January 1 through December 9th treated as this for the SALT limitation workaround. It's only after the date of incorporation. So obviously incorporating at the end of this year would not help you for 2021, but it would get you set up for potentially 2022. So there's two qualifications. One, the entity, and then two, the individual shareholders, because there's restrictions on who the shareholders can be. So at the entity level, we know it's S corps, partnerships, LLCs taxed as a partnership. At the owner level, it's individuals, trusts, and estates. And so if I have a client, they are a general partnership. They're dentists that have a general partnership, or physicians or anybody else. They have their general partnership at the top. And then the partners are their individual S corporations. The general partnership may make the election to pay the taxes, but the individual owners, the S corporations, would not get any benefit. So what we're usually going to be seeing is the general partnership doesn't make the election to pay in the taxes. The individual S corporations, the partners of that partnership, will make the election and then flow the tax savings down onto their individuals. So again, general partnership, two S corporations, the elections made at the S corp level, not at the general partnership level. And I know that could get a little confusing. Now, with regard to who qualifies, if I have a business, an S corporation that has multiple shareholders, our general partnership, we're seeing this a lot with our Kaiser doctors. Each individual partner can make the election. Each individual shareholder can make the election. The downside on an S corporation is that if there's two of us and I make the election and you do not, what happens is the corporation takes the tax deduction, call it $10,000. But because corporations have to spread out the net profit equally, we can't allocate certain deductions in an S corp level. The non-electing partner is going to get the benefit of the lower K1, right? So the whole $10,000 doesn't go on to my K1. It's split equally between the partners or based on their percentage in ownership. In a partnership, though, and an LLC that elects to be treated as a partnership, the partnership can do specific allocations. So they could say, you might need to amend your partnership agreement or your LLC. And basically what you would do is you'd say, for those partners that elected to pay in this this extra tax, that tax will show up on their K1s and not on the K1s of other individual partners that didn't make the election. So partnerships have a lot more flexibility than S corporations. The benefit for our clients is most of our S corporation clients are solo owners, so it won't make too big of a difference. But if you have multiple owners on your S corporation, you got to be aware that there could be some benefits paid on for the partners that don't make the election, right? Now, they're not going to get the state tax credit. My understanding is that that tax credit should go to the partner, but we probably need a little bit more clarification from the Franchise Tax Board how that's going to work. A couple other things on the elections. This election is made annually and it's irrevocable. So if I go in and I make the election for 2021, and then I later find out that it's not effective, I can't go back and amend that tax return and get rid of that election. Once it's made, it's irrevocable. The other thing is it's a yearly election. If I make the election in 2021, I could forego making that election in 2022 or 2023. So I could pick and choose what years I want to make this election for. Now, I'm going to touch on it a little bit later on, why we may not want to make the election every year. And so just hold those thoughts for a little bit. Now, 2021 is a strange year, right? Because the law came in midway through the year and people are going to be looking at it and go, December 10th, I only have 20 days in which to effectively try to figure out if I want to make this election. So that there's some special rules as it applies to 2021 that will not be the same as 2022 and 2020 through 2025. The primary one is the date that we have to make this election for 2021. This is the current tax filing season that we're going to be heading into, is March 15th of 2022. Okay, so we could technically make this election later on in 2022. Now, the tax benefits may not be as great, and I'm going to touch on that a little bit on the next slide. But for 2021, it's important to know that we have up until the original timely filed return. And the Franchise Tax Board has come out and said that includes extensions. So technically, if you wanted to push this election out, you could go all the way as an S corporation to September 15th to make the election, to have the flow through, the AB150 credit put onto our personal tax return. 2022 through 2025 tax filing years, the election is also by the extended filing date of the tax return, but there's a trick. The first payment that we have to pay in is June 15th. And by this, I mean, so the corporation, the partnership, it's going to have to pay in the elective tax, right? Typically, we're going to pay that money in along with, if we think about it like our defined benefit contributions, we will put a liability on the books and then we'll pay that liability when we file the tax returns or fund the money sometime in the next year. But here, what happens is, even though we might have until September 15th of 2023 to make the election for 2022, we have to make the first payment of that money by June 15th. And what this is effectively going to do is make us make that election, whether we're going to comply or take advantage of AB 15, not by the due date of the return, but by this June 15th payment date. So to give you an example, 2021, I could say, I'm going to make the election for this elective tax in March 15th, 2022, or even September 15th, 2022. The problem is in the 2022 tax year, that election, because I have to pay in money, has to be done by June 15th. So it's going to get a little bit wonky with regards to the timing of when we make these elections, for what tax year and stuff like that, just because 2021 and 2022 have different timing deadlines on this. So the next one, when is this tax due? When do we have to pay the tax? So we could pay the tax again, like March 15th, 2022. The downside is the IRS has come back and said, we're going to only get the tax deduction at the ND level in the year we paid that tax. So go back to 2021. Steve says, I'm going to make the election March 15th, 2022, that I want to take advantage of AB150. And I pay the elective tax March 15th, 2022 for the 2021 year. I do not get a tax deduction on my 2021 return. Okay, that deduction will occur in the 2022 tax return. So if you're going to make the contribution for federal tax savings for 2021, that contribution needs to be made before December 31st, 2021, because it's the year that we make that payment is the year we're going to get the deduction, even though we can make the election at a later time. A little confusing on the timing and stuff like that. So as I mentioned, with regards to 2022 through 2025, the entity has to make two payments. The first payment is due this June 15th that we talked about, and probably likely when we're going to want to make the election for the 2022 tax year. That payment has to be the greater of 50% of the prior year elective tax, or $1,000. So if I don't make the election in 2021, and I'm going to say, I'm going to start doing all these elections 2022 when I fully understand this law, all I would need to make is a $1,000 payment by June 15th, 2022 to make that election. If, though, Steve says, I'm going to try to take advantage of the 2021, I'm going to send in the calculated $40,000, then come for the 2022 year, if I want to participate by June 15th, I have to pay in $20,000, 50% of that $40,000 payment I made. So it's the greater of 50% of the prior year payment or $1,000. So those are going to be a little bit different. What happens if for the 2022 payment, Steve paid in the $40,000 for 2021, my minimum payment is that $20,000, but my revenue is significantly decreased. Do I pay in a lesser amount? And Franchise Tax Board said, no, you still have to pay in that 20% or 50% of the prior year amount. So you can't default to that $1,000. So you got to be really careful when we're looking at this. And we're not only looking at 2021 numbers or 2022 numbers, we need to forecast for future years, 2023. Do I think my revenue is going to be up, down, about the same? Because it could play a little bit of havoc with regards to how much money we're having to pay in. Because remember, this is a credit towards our state tax returns on the individual level. One thing I don't think I touched on is this tax credit is non-refundable. So if we pay in hundreds of thousands of dollars to California and we only get to use $50,000 of the credit, as I'm going to touch on in the next couple screens, we lose all that additional credit come 2026. So it's not going to, the credits stop, this loss stops at the end of 2025. So that's going to get a little confusing, and why I think a lot of people are going to elect to do this every few years. I think there's a really small subset of people that may be able to take advantage of it every year, but for the vast majority of us, we're going to probably need to do this election once every 2-3 years. And we're going to have to time that last one because we want to make sure we use up all the credit before the end of the 2025 tax season. Otherwise, we just gave a real charitable contribution to the state of California. So this gets back to that, when are we entitled to the tax deduction at the entity level? And that's in the year that we actually made the payment. I put the Franchise Tax Board form down here, 3893. This is the form that was released so that if we're going to make this payment prior to the end of the year, this is the form that we're going to want to submit to the Franchise Tax Board along with our payment. Franchise Tax Board 3893. Okay, so what are some of the pros and the cons of doing this? And we touched on it. The biggest benefit, obviously, is the money that we send in as this elective California tax is going to help reduce our federal income tax. And so assume an S corporation has pass-through income of $1 million, right? The entity level tax is 9.3% or $93,000. If the shareholder's in a 35% tax bracket, they've helped by doing this elective tax reduce their federal tax on their individual return by 35% of that $93,000 or $32,550. So by sending in this money, we drop our federal income tax liability. That's the number one benefit. The number two benefit is we pick up a $93,000 credit on our California individual return. That's no different than if I sent in $93,000 as an individual estimated payment, right? I still get the money applied to my personal return. The difference is I now pick up a federal tax deduction for that payment. Whereas if we look back at those original screens, our SALT cap deduction is capped at $10,000. This $93,000 coming from my entity is that workaround on that $10,000 cap. Because if I sent the $93,000 in individually, I wouldn't get the credit for the $93,000. I'm capped at that $10,000. So, like I said, when I first started hearing about this, I'm like, this is a no-brainer. Why wouldn't everybody just elect to do this? And so let's look at some of the drawbacks. First drawback is we're going to be taking money out of our entity, right, and paying it in as an elective tax to California. That's going to affect our cash balances, and it's going to decrease our cash flow. So if we have large equipment purchases in the next year, things along that nature, this may not be the best time to make this election because we're going to reduce our cash balances and we might not be able to afford those extraordinary expenses going forward. Another one, if you're not in learned profession or one of these businesses where the QBI deduction is not phased out on you. So obviously attorneys, doctors, dentists, our QBI deductions reduced just based on the fact that we are attorneys, doctors, and dentists. However, let's say I have a trucking business that doesn't lose out because of the amount of income they have on the QBI deduction. Understand that when we lower our federal taxable income on that K1, we're also reducing our QBI deduction. Excuse me. So in that example before where we had the $1 million of income, right, here on the K1, the QBI deduction, which is 20% of that K1 amount, is going to be lowered. So in this case, would be lowered 20% of the $93,000. And that's going to help reduce our taxable income down about $6,500. So the savings for people able to take advantage of the QBI deduction is not going to be as great as the savings of people that get phased out of the QBI deduction. So just something to consider. I have I think I have an example showing how it really affects you. It's not going to be that great, I don't think. So it's something to consider though. Probably the next biggest one is the shareholders receive the tax credit. And I touched on this. That tax credit may not be used up fully in the year we pay that money. There could be a carryover of that credit to future years. And if we're carrying over money for California tax credits and the bill expires, that money's lost. So in our example, the shareholders receive a personal tax credit of $93,000. However, the taxpayer may not be able to use the full credit in the year the entity paid the elective tax. The way that this was written up in the law, and this is going to get a little technical. Let me step back. So on our federal returns, before we used to hear a term alternative minimum tax. And basically what the alternative minimum tax was there for is for people that were taking excessive deductions, whether it be taxes, paid to the state, charitable contributions, whatever it might, miscellaneous deductions. And what they did is they came out with this flat tax called the alternative minimum tax. So they'll take your taxable income. For the federal purpose, it'll multiply it by either 26 or 28%. And they're going to compare that versus your regular tax. And you end up paying whichever one's higher. California, which a lot of people don't know, also has a tentative minimum tax. And so with this law, the way it was written up, the way they wrote it, is they said that this credit that you receive could reduce your regular tax, but not below that tentative minimum tax. And this is where the big issue is. So if my regular tax is, let's call it $80,000 in this example, and my tentative minimum tax is $60,000, all I'm able to do is use $20,000, the spread between those of this $93,000 tax credit. And that other 73 is carried up into 2022. And if I don't use it there, to 2023. And if it's not all used up on the 2025 tax return, I lose whatever the remaining balance is. And this is why I think a lot of people are going to end up electing maybe every other year or every third year, or maybe only making the election once, right? Because if that spread between the regular tax and the tentative minimum tax is high, it's going to take us multiple years to use up this full credit that we paid in on any given year. So I think this is going to be the number one thing that we have to plan around when we're looking at this. So I know it's a lot. And what I want to try to do is try to show you how the numbers work out. And then I'm going to go through and I'm going to answer any questions that you might have. Feel free to type them into chat. I think I'm not even sure how many people are in the meeting, but it doesn't look like a lot. I might just turn off the mute. And if you want to ask a question, we'll just go back and forth, just like if we're having a regular tax meeting. So is it right for us? And I'm going to go through a couple examples here and show you how this tentatively works. And I will try to, on the first couple, I've actually printed up the tax form that shows the spread that these numbers explain. So let's look at a taxpayer, $800,000 of income. $300,000 of that is through wages or other forms of income, dividends, capital gains, whatever it might be. But I just, for this example, put $300,000 of wages. And the pass-through, that K1, is $500,000, the entity level income, right? The business is required to pay 9.3% of this $500,000, or $46,500. That is the elective tax that the entity is going to ship out to the state of California. When we look at it, based on this $800,000 of income, our regular tax is $70,000 and change. California's tentative minimum tax is 7% of all income, right? So 100,000 times 7% is $56,000. And like I said, in any given year, we can only claim the credit equal to the spread between our regular tax and our tentative minimum tax. That just happens to be $14,000, right? So the entity pays in $46,000 on my behalf. It reduces my federal tax return, which is great. But out of this $46,000, I only get credit on my 2021 tax return, or the year that I made that payment, of $14,000. So it's going to take quite a bit of time, 3 years, maybe close to 4 years, for us to recoup the full benefit of that tax credit. So I might make the election in 2022 and then say I'm not going to make one in 2023, 2024, or 2025, because I'm not going to be able to use up this credit every year. Okay, so, and we don't want to, like I say, give California free money where we don't need to. One thing as I was working through these examples that I found is this aggregate gross receipts. Now, what aggregate gross receipts are, as the shareholders or the partners share of the gross revenue the business has. So obviously, if I'm a single, owner S corporation, it's whatever my gross receipts are. In my case, whatever my collections are. $950,000, my aggregate share of that is $950,000. If it's $1 million, my aggregate share is $1 million. If there's two of us, our aggregate share now is $500,000, right? $1 million divided by 2, $500,000. Why this is so important is that there is an allowance in the tentative minimum tax that says if our aggregate gross receipts per partner is under $1 million, when we are calculating this tentative minimum tax, we do not include the pass-through income. So obviously here, and I'm going to show you exactly how this works out in the next example. So let me fast forward a little bit. Here's how it looks on the tax return, right? If we look back, the regular tax, $70,439. That's reported right here. Regular tax, $74,439. The tentative minimum tax, as you can see on the California, and this is Schedule P. I put it in the note right here. California Schedule P. The minimum tax, 7% of that 800,000, $56,000. And again, we get that credit of 14. But what I wanted to show you is this is the exact same example using the same information, 800,000 of income. W-2, 300,000, K-1, 500,000, but the gross receipts are under $1 million for the partner. And where this planning would be is I'm looking at a large commission check, or a large potential settlement. Do I try to push that settlement off, or that income event into the next year if I'm close to this $1 million mark? Because it makes a big difference. So if I back out the $500,000 K-1, because it's not included in the tentative minimum tax, we're going to see our tentative minimum tax drops to about $14,000. Our regular tax stays the same, right? Because it's still the tax on all of our income. The big difference is that spread now is $56,000. So if I paid in 46, I get all 46 on my current tax return, and I'm not carrying that credit forward. And this is why I think when I mentioned, you really need to dig into your numbers. You need to know exactly how much you're making for a given year. Your projections have to be spot on. Because if I say we get all 46,000 on this tax return, and it turns out that we're here and we only get 14, we've just wasted a lot of money in that particular year. And I'll go through that. So the entity would pay, the 46,000 in state tax. The investor would get the 46,500 tax credit on their current tax return, which is a big benefit, right? And how it looks on the tax return, as you can see, the gross receipts for the calculating the tentative minimum tax are much lower than the 800,000 on the prior example. And that $56,000 spread is what we're able to take up to on the taxes. Okay. Next example. And this is, I'm a general partnership. All the money I receive is through flow-through income, and I don't get a W-2 or any other income. So I'm assuming here the entity itself is all my income, right? So 1.3 million. 1.3 million times the 9.3% tax rate turns out to a credit of $120,900. And so what happens here is the entity ships up the $120,900 as an elective tax. The California regular tax on that 1.3 million is $127,000. California minimum tax, 7% of that 1.3 million is 91. And again, the excess is 36. So if we look at it, we pay California $120,000 in tax. We reduce our federal taxable income, multiply this 120 by our tax rate. But for California purposes, we only get credit of $36,453 on our current year tax return out of this $120,000 we sent in. So that's a big loss of money going into California. So it would take approximately 3.3 years to recoup this full credit. Again, going back to, we may do this in 2022, year one, 2023, 2024, and then we get a partial credit in 2025. But if this is your situation, you would not ever, I don't think, make this election in tax year 2024, because what will happen is you get the federal benefit, right? But you're giving California almost $84,000 of additional money you are not going to see come back on your personal tax return. Hope that makes sense so far. I know it's going fast and it's a lot of math, and we don't like doing math on Fridays. So example 4, same thing, same income, 1.3 million, but pass-through income is 900,000, much going back to the first examples. Other income's $400,000, right? Business pays 9.3 of the 900,000, $83,700 going in. The tax is still the same, $127,000. The $91,000 is the same as the prior example, right? The tentative minimum tax. But what I wanted to point out is that the business only paid in $83,000 as opposed to paying in the $91,000. So we're going to eat up that tax credit a little quicker in this example. So now for planning purposes, maybe I can make that a last election, 2023. I get to 2023, 2024, and a little bit over in 2025. Whereas in this one, if I make it in 2023, I just lose a lot more of that credit if all the facts stay the same year in and year out. And that goes back to when we're making these elections, we sort of got to project what will the income be in the next year. So let's say I'm a dentist and I'm thinking about making this election now to try to save on the 2021 taxes. However, in 2022, I'm thinking about maybe selling my practice. I'm going to do an asset sale. All of a sudden, the income coming into my business is going to be much higher. The entity is going to pay a much higher credit towards it. And so if I have a carryover going into 2022, because I made the election in 2021, and now I pay in a ton more money in 2022 because I had a liquidation event. Maybe I sold, the assets of the business. Then all of a sudden I'm going to be carrying this large credit because it's going to be the 2021 unused credit plus the 2022 credit heading into 2023 where my income is significantly reduced, right? And so I might not be able to get the full benefit of this credit. And more than likely what's going to end up happening is I'm going to lose a large portion of this credit. So when we're doing our planning with regards to the AB150, we need to know what our future events are going to be as far as income. Now, if I'm really consistent, like I do, $800,000 a year. In the last 3 years, I did 800,000, and I'm thinking I'm going to probably do the next 3 years 800. Makes it a lot easier to sort of plan, right? But if I'm thinking, well, the stock market's really high, I'm going to be worried about the stock market crashing, so I'm going to sell off a whole bunch of my Amazon stock. All of a sudden, I got an artificial bump in my income, and then if that's the case, I might not be able to use the full credit up, and that's what we need to be aware of when we're doing this stuff. So again, like I said, the 2.3 years because the entity level tax that was paid in is less. Example 5, going down a little bit lower to the lower, the mid-level income. Let's say the pass-through income for the business S corporation LLC is 175,000. We have wages of 115, so our total adjusted gross income is 290. Entity pays in the 9.3 or $16,000. And what I wanted to point out with this is the tax savings. So that 16,275 multiplied by our tax rate is $3,906. But because we're reducing our pass-through federal tax, we're also reducing our QBI deduction, which is 20% of the flow-through income. So we lose this $16,000 deduction. So we lose $3,255 of our QBI deduction, multiply that by the 24% tax rate up here. And we find that the loss of the QBI deduction actually increases our tax liability $781. So our net savings isn't just the tax savings on that 16,000 that we paid in, the 39. We reduce that. And so our overall savings when we calculate in with the QBI deduction is only 3125, right? So TMT equals, the regular tax, which would be 20,250 minus the minimum tax of 13, our spread $6,930, and it'll approximately take 2.35 years to pay that off. Client would need to pay the 16,000, and this is where it gets into the cash flow, right? So California entity pays in 16,000. We save $3,100 in Fed tax. We get a tax credit of $6,900, right? The spread. And what ends up happening is we're out of pocket $6,221, right? 16,000. We get back the tax savings, 3,100. We get back California tax credit of 6,900, and then we're short the $6,221. So we're ending up paying a lot of money in 2021. Cash flow wise, and we're not getting the benefit of the full 19,000 that we sent in. Matter of fact, $6,000 gets carried, or the money gets carried forward. So we're not going to be able to recoup the full benefit of tax savings and money paid in, and probably until year 2 on this. So like I said, it goes into tax savings, our tax planning, cash flow planning for our business, because we're going to be out a lot of money. We're not going to reap the full benefit of that money until probably year 2 or 3. And so those are some of the observations when you're thinking about doing this. Are you willing to wait? Because remember, you're out of pocket this $6,221. That's $6,221 that is not working for you. If you look at the stock market or S&P, I don't know how much it's up, but it's up, 10, 20, 30%. we've lost the use of that money, and that could go into our financial planning aspects of doing these kinds of projections. Some observations. So talked to a lot. We were in a tax class through Spidell Publishing yesterday, and that's where I got a lot of the information for these spreadsheets. A lot of practitioners are thinking about foregoing the election for 2021. One, there's not a lot of time to make accurate projections. Two, there's a lot of things playing into that are currently pending in Congress that could affect this tax deduction. And so a lot of them are recommending to their clients, and unfortunately, we're going to probably recommend to the vast majority of ours, that we hold off on doing any of this planning until 2022, until we know exactly how this credit's going to work out. And some of the things that are being proposed right now is the Congress, the House, submitted up their tax plan. I think it's under the Build Back Better program, but what their House is suggesting is that we take the $10,000 SALT limitation and increase that to $80,000, right? And so all of a sudden, this doesn't become attractive, right? Might as well just take the money and then just pay my estimated tax, because I'm going to get full credit for those estimated tax payments or the extra withholding. I don't need to jump through all these hoops and potentially lose that credit if it's not fully used up by the end of the bill. So that's number one going out there. Number two is the Franchise Tax Board, California Franchise Tax Board, is talking about, and we don't expect to hear anything until probably March, April, May of next year, talking about getting rid of that spread component and just basically saying that the credit flowing through from the entity level can be used not only to offset regular tax, but minimum tax. And if that's the case in 2022, then it sort of becomes a no-brainer, right? If my entity pays in $90,000, I'm going to get all $90,000 to help offset my California taxes. We're not quite sure if they make that pass it, right? Will it be retroactive to the 2021 tax year, or will this only be for 2022? So, like I say, the hesitancy is out there, right? Personally, I don't think the Senate's going to pass the bill, but if they do, we lose out on we lose out, right? If California Franchise Tax Board comes back and it says it's going to be used to not only offset the regular tax, but also TMT, we potentially lose out. So it's a risk versus rewards. And since more than likely we're not going to be able to take this credit every year, I think the conservative approach would be to make the election in 2022 for the 2022 tax year, so we don't stand the opportunity to lose on any monies that we may have paid in 2021 for 2021 tax year. Hope that makes sense. And I'll answer any questions if there's confusion going on. I already touched on this. Don't just consider your current year. We got to look at future years to see if we're going to be making the election every other year, every third year. What we don't want to do is lose this 5-year carry forward, because at year 6, we lose any extra money that we paid into California. The other one is we don't want to be, we got to be, I guess, cautious about overestimating. Maybe, like I say, I think I'm going to do, hopefully, realistically, I'm going to make $900,000. And so I'm going to make the payment based on that $900,000. Yeah, I save on the federal tax, but remember that credit's going to be a lot higher. And then that credit could expire and we lose out on that extra money we paid in. So we got to be really cautious. And like I said, it goes back to having accurate books as we're making these projections going forward and stuff like that. Because you don't want to pay California more money. They're going to just sit on it. They're not going to pay you interest on it. And then if it expires, it's a free gift to them. And this gets back to this non-refundable. Overpayments of estimated tax are refundable. There's a question pending with the Franchise Tax Board. If this credit is non-refundable and estimated tax payments, if I overpay my taxes, I'm entitled to a refund. Which is going to take priority? Is it going to be that we're going to use up the credit first and estimated tax payments last, and then we're going to get a refund of our estimated tax payments? Or are they going to apply the estimated tax payments and then the credit and say, well, the credit, you used up most of it, but not all of it, and you're not going to get a refund on that. So it's going to be a timing issue, and we're waiting for the Franchise Tax Board, hopefully in 2022, to come back and let us know how are they going to apply things, credit versus, versus estimated or withholdings, and how are they going to credit these back as far as a timing issue. I mentioned them before. Can highly recommend Spidell Publishing. The information I got off of for this, a lot of it was on their 2021, 2022 federal and California tax update. So I want to give them thanks, because I was putting this together, struggling with some of the spreadsheets, and literally we had the tax meeting on Wednesday, and I used their information to help supplement this presentation. So I know a lot of you have questions, so I'm going to stop the share. One thing I'm going to try to do, if I don't totally screw this up, let's see if I can get here for a second. I am going to try to drop in the chat box the PowerPoint so you guys have it, okay? So let me see if I can bring this up and share it. Let us know if you don't receive it, because I know sometimes on, oops, let's see. I know sometimes if you're on iPhones or iPads, it doesn't necessarily share with you. If that is the case and you don't get it and you want it, please email Katie. I'll put her email address in the text, so you have it. Just let her know, and then we will send this out to you, this presentation out to you. So it's katie@schroederesq.com. You could always email me too, and I'll send it out to you. But let me see what kind of questions there might have been out there. Yeah, as one of the questions, are disregarded LLCs eligible? As I said, no, they're unfortunately not. So typically what you want to do with a disregarded entity is make an election, add your spouse on, and then elect to be treated as a partnership. There's case law that says husband and wife in a community property state are treated as one taxpayer. If that's the case, then maybe we look to add another entity, maybe your S corporation on as a partner to the LLC, trusts, things along that nature. Yeah, so how's the 2021 gross income calculated now? Again, it's an estimate. So you're going to use your best effort to try to calculate the 2021 income. And that's where the hard problem becomes, right? Like, it's all income to determine your total tax, and the tentative minimum tax. And so if you just do it based on the income and you forget your wife's W-2, or you forget that you had a liquidation event, I sold that Amazon stock, we're going to be put in a position where these projections on how much to pay in and how fast you're going to get the credit back are going to just be way off, and you could end up harming yourself. So really hard to do with only 20 some odd days left in the year to do accurate planning. That's why I think a lot of people are saying default to 2022. And that way you know to keep track of your income. Like, unfortunately, in 2020, when the pandemic hit, I liquidated some stock, and as your accountant, full disclosure, totally forgot about that liquidation event until I got the 1099 from TD Ameritrade saying I had an extra $100,000 of income. And I was like, damn, well, if I'm doing my projection for the 2021 elective tax, and I forgot about that $100,000 earlier in the year, I could really screw up my tax projections and how this credit could potentially help us. Let me know if you received it. I know a couple of people are asking about the handouts. I sent them. I see a couple of people got rejected. Again, it's showing us disk error space on some things. If, like I say, if you don't have it, feel free to email us and stuff like that. If you have questions, let us know. If you have friends that may benefit from this, I'm going to upload it to our YouTube channel probably in the next couple of days. No fancy bells or whistles. It's going to be the exact same presentation you guys just got here. And then hopefully, if it helps them, great. If they have questions, great. Unfortunately, for a planning standpoint, next Friday, I'm taking off for a week. I'm going to Hawaii. So that leaves very little time for our office to do the projections for you. But if it is something that is interesting, call up and we can see if we could do the projections to find out how it might best work. Again, I think that a lot of the default's going to be moving this election to 2022. But I wanted to get this presentation out there because if you look up AB150 in Google, you're going to see a ton of recent, articles by CNBC, by Forbes, all these entities. So a lot of people are asking about a lot of questions on this. So Thank you very much. I don't see any more questions coming through. Again, if you have a specific question, feel free to email us, give the office a call, and we'll try to work with you. It's just unfortunate we're a little tight on scheduling right now. So thank you very much, and I will talk soon. Bye.